Hi everyone, welcome to today's video. So there is a lot of news coming around the fact that India has become the fourth largest GDP in the world. There are two categories of people now. One category is saying that, India has become an economic force to reckon with. We are the fourth biggest financially powerful nation in the world, and the world should bow under us. Okay, so that's one category. The second category is saying that, boss, fine, we are the fourth biggest, but roads are poor, infrastructure is not there, GDP per capita is really bad, all that stuff. So which story is correct? I'll give you a data-based perspective on this. Even if you're a class 10 student, you'll understand everything that I'm teaching on this video because I will teach in very simple language. For investors, at the end, I'll give you like a summation point, which is very, very critical and important as to what will happen in the next 10 years in India, what is the expected growth rate, and how it will reflect into the markets. So please listen to all the points. I'll break it down in very simple, easy to understand language. So let's begin. And here is the news item. And it basically says that India has become the fourth largest GDP, and it has recently surpassed Japan, right? Now, what is the meaning of GDP and how is GDP calculated? How is it different from GDP per capita? This is the first basic thing that you should know as an Indian citizen or citizen of the world. Okay. So here is what is the meaning of GDP. So GDP in very simple terms means that it is the summation of or the total of all the goods and all the services that are produced within a country. Now, imagine that India has 100 factories. Okay. Now, these 100 factories are going to produce, let's say, 1 crore worth of good every factory. So 100 crores, right? So 1 crore multiplied by 100. So 100 crores worth of goods are produced in India through these 100 factories. What about services? So India might have, let's say, 150 call centers. Now, every call center might be producing 1 crore worth of economic value add. So 1 crore multiplied by 150, that is 150 crores. So total GDP of India becomes how much? 100 plus 150, 250 crores. So this is how a GDP is calculated in very simple, easy to understand language. Now, how is this different from GDP per capita? So we can use a very simple example of two houses, right? So let's say that there is a house A and there is a house B. In house A, there are 10 family members, right? And in house B, there are only 2 family members. Now the collective income of house A is 10 lakh rupees. And for house B, it is 5 lakh rupee per year. Now, which house would you say is richer? Now, let me know your answer in the comment box. And here is the explanation. And it's very simple. That's see, on GDP terms, what is the GDP of house A? Well, it is 10 lakh. Okay, so that is the GDP in simple language. Here is what is the GDP? Well, it is 5 lakh. But GDP per capita is what? It is per person GDP. So for example, if you take this 10 members and divide it by 10 lakhs, it comes out to be 1 lakh rupee GDP per person. Here, the GDP per capita would be 5 divided by 2. That is 2.5 lakh. So on GDP per capita basis, house B wins. But on overall GDP, house A wins. Now, which matrix is better? Is it GDP per capita, which is like a better indicator, or is it GDP, which is a bigger indicator? So for that, we need to move to the concept of developed nation. Now, typically it is seen that in countries where GDP per capita is high, those nations are considered to be developed nations because the economic output per person, if it is high, which is GDP per capita is high, then what is happening? Basically, those people are generally rich on per person basis. They would get some free time, so they will be happier. Well, they will invest in like better health, education. The society would be less crime oriented. So all this reflects into a nation becoming developed. So natural question comes that, hey, is India a developed country or it is a developing country? Well, from an income point of view, we are not a developed nation right now. We are not even a middle income nation right now. We would be considered as a lower middle income nation. Now, why is that the fact? Because our GDP per capita is roughly $2,000. So it is not that high. It is actually very low. On GDP per capita ranking, we are ranked somewhere around like 135th. And on GDP, absolute GDP basis, we are ranked 4th. So which brings us to the next question that, hey, why is there so much discrepancy that on GDP basis we are ranked 4th and on GDP per capita basis we are ranked like 135th, 140th? Why such a high discrepancy? It's very simple because GDP is what? GDP is a collection or a summation of goods and services which is produced within a nation. Now, who produces it and what is the biggest function here to produce like higher volumes of goods and services? Well, it's the population. So India's population is one of the highest in the world. So if we have so many factors of production or people producing something, then of course the GDP is going to go higher. Now, does it mean that GDP per capita will go higher? That's another debate. So which brings us to the next point, that okay, for India to become a developed nation, what is it that India needs to do? That number one, we should acknowledge where we are lacking and stop playing around with data. Now, what does that mean? So for this, let me show you like a very interesting case study which you would not know about GDP. And basically this chart indicates India's ranking as per different years on GDP. Okay. So for example, in 2008, we were ranked 12th, then we were ranked 11th, then 9th, then again it went up, right? So we started ranking 10th, and then suddenly here Modi ji came in power, okay, and we jumped 3 places. Such a jump was never seen. Okay, so now naturally question will come that okay, in what? Okay, in 1 year, so many roads, hospital, bridges, murtiyan, etc., were built. The short answer is no. Okay, here what happened was that we changed the way GDP was computed. Now please note that I am not criticizing the new methodology of computing GDP. That is beautiful. It should have been done earlier. What I am criticizing is the fact that, hey, you know what? No one told you this, that, okay, suddenly the reason for the spike in GDP was that we changed the computation method. Please again understand, I'm not trying to criticize the new computation method. It should have been done earlier. What I'm simply saying is that no one communicated that, hey, this jump from 2014 to 15 is a statistical adjustment. It's not real GDP growth per se. Okay, so this is financial engineering in a way, right? And which is not very nice, right? So this should have been told to people. So I am trying to bring it to your notice. So number one thing, that if India actually truly wants to become a developed nation, the first thing that we should start doing is that start being honest a little bit, make people rational thinkers, create an ecosystem where honesty is valued. If that is not valued, then you can never have like a well-functioning society. There will be people who will be tricking you right from the top all the way till the bottom. It will become a deeply corrupt market. So corruption just kills everything. Okay, so like unless we have like a little bit of honesty, honor left in the world, in India, like I mean, nothing will move. Okay, so this is literally one. The second key thing that needs to happen for India to become a developed country is that we need to reduce our dependence from agriculture into other gross value added industries. Now, what is the meaning of this? See, basically when people are doing agriculture, there is only a certain amount of income that they can make. Close to 50 to 60% of our population depends on agriculture. Now, this is very high dependence. No developed country in the world has more than 5 to 7% of their population depending on agriculture. Here's the case study on France, and even there, the population, only 5% depends on agriculture. So second key strategy for India to become a developed country is that we need to move to better gross value added industries. So we have to move from agriculture to manufacturing or services, whatever that is. But we need to figure out new income streams which are more gross value adding. According to me, tourism is a great area which India can explore. If our laws function, if people do not have that socialist tendencies that, you know what, tourists are destroying this, that, and they open up to tourists, behave properly, do good things, keep their cities clean, etc., all that will lead to more beautification. There is enough demand for tourists to come in India. Here again, you need to understand the concept of domestic tourists versus international tourists. See, when someone from Goa goes to Gujarat to see a statue, okay, is it like really adding to your GDP? Technically, yes, but honestly, it does not create like any practical benefit. On the flip side, if someone from Spain is coming to Goa or Gujarat, now that creates additional money because you're bringing foreign wealth. That's more valuable. Third is the GDP growth rate itself. So right now the data tells us that we are growing at 6.5% GDP growth rate. This is very, very slow for India. If you just try to investigate that at what rate India needs to grow in order to become a developed country, you will get an answer of somewhere around 8.5% of GDP growth for a 20-year period. Now, this is very interesting because if you just go and look up the data. Now, if you take a look at the GDP growth rate of India, let's start from the year in recent history. So let's start from 2010. So this video is not political, right? I'm covering like every government. Our growth rate was 10.3, right? But was it sustained? No, right? It was 6, 5, 6, 7, 8. 8.2. I think these 2 years were good. And again, massive slowdown, then massive slowdown for like 1, 2, 3, 4 years. Then little bit. If you take the average, we are not growing at more than like 7.5%, right? Maximum, right? So this is very, very slow because we are missing the target consistently. Now, this is not good because India's population will peak in 2065 and GDP is a function of population. Right now, our population or demographic dividend is helping us. But as we become like Japan, which is primarily a country of old people, we will witness new challenges. So not maxing out the energy of young people right now and pushing them towards high GVA or gross value add industry is not something that is benefiting our nation. We are growing really slowly. In fact, this is India's golden period. We should be growing at at 10% plus, right? But we are doing a really bad job in terms of growing at only 6.5, right? So this is the reality. Natural question comes that, hey, how will we grow from 6.5 to let's say 8.5% growth rate? Well, you need to, number one, move people out of agriculture. You need to move people into manufacturing, or you need to move people into services. You need to create, in simple words, high quality jobs, right? So high quality jobs is what India is struggling with, and it's reflecting into our numbers, and it's derailing our plans of becoming a developed country. Okay, so then comes the next very important question for investors, that okay, fine, you have discussed like an important topic, GDP, and but how does it relate to me investing in India? Because I'm like 25, 30 years, 35, 40 years old. I'm putting all my life savings in India. So how does it impact me? Well, long story short, GDP and stock markets do have a very strong relationship in India. Now, the way this relationship works is that, for example, if GDP is growing something like this, okay, so it will go up and down and all that, the stock market will somewhat follow it in the long term, right? It might not exactly mirror it, right? It might, for example, fall here, but it will generally follow this trajectory, then it will fall here, then it will follow. So it will follow this curve one way or the other on a long-term basis. So there is a very, very strong interlinkage between GDP and the stock market growth in a country like India. So, okay, so let me now explain you like a stock market return equation. Now, stock market return equation can be cultivated by looking at the GDP growth rate that I just explained you. Now, here what you need to understand is the concept of real GDP and nominal GDP. So, nominal GDP means that it includes inflation, but real GDP does not include inflation. So this 6.5%, what we are assuming is the real GDP growth. Also, now some of you would say that, hey, why am I taking like a 6.5% growth rate? Well, the answer is very simple. So this is the average 3-year growth rate, because whenever we are investing in the market, we consider like 3-year averages. So here you will see that, hey, in this period, it was only 4.1, then 8.4, 9.5. So right now, India's GDP growth rate is slowing down. Next 2-3 years do not look great. So therefore, that 6.5% is an optimistic number that I'm taking. Okay, so and I'm running my computation accordingly. Now, let me explain you the formula. Now, if you add 4% nominal, which means 4% inflation, the GDP growth rate will be 10.5. Now, out of this, there will be more business going to organized sector. So there will be more wealth growth in the organized versus unorganized sector. And if you run the entire approximation, we are roughly looking at 13% CAGR on Nifty 50. Now, this is a wonderful equation to keep in mind, and accordingly, you should design your portfolio, right? Keeping this equation in mind. Is it good? Is it bad? I don't know. Because again, then you need to start getting into the debates around what the real inflation in the economy is, what the currency depreciation is. Now, long story short, one of the biggest problems, right, in this 12 to 13% growth story is a simple question, that where is India's real growth coming from? I do trust the Indian market that we will do eventually something nice, but right now it's very difficult for us to figure out that point. Okay, so my personal investment strategy would be that if I'm getting a market which is cheaper than this valuation, I will buy it. But if I'm getting a premium valuation over this, where the growth rate kind of is misaligned with the stock market growth rate, then I will sell the market. This is what I'm currently doing, and therefore I've rotated a large chunk of my money into the US market, which is already at very nice profits. I have making 39% CAGR on it as of today on the public portfolio that I have created. Right now, there are better opportunities in the US compared to that in India. Maybe 6 months from now, Indian market will be undervalued. When I say it will be undervalued, I will pretty much be aligning my investment decisions in India based on this equation. I hope that you enjoyed this conversation, the investment side of it. It gave you clarity, and it gave you like a foresight to read data more. Thank you so much for watching, and I'll see you soon.